Hello, everyone, and welcome to today's major markets update for Friday, the 20th, 2022. What a nice round set of numbers. Is that maybe the date the markets decided to put in the low? Whatever the low is, I don't know, or the top, but a low or a top is, I think, a better explanation. But we now had a lower low compared to last week. That means the recent rally was most likely that fourth wave of that tricky, expanded, irregular, flat fourth wave. Remember, 4 hours of price action can make the difference between 5 waves up for a wave 1 versus 5 waves up for a C wave of a fourth wave. Quite amazing. But with the lower low, we now know that was not a wave 1. So we have fewer Elliott Wave options, essentially only one left. I'm really running out of options. And that is a good thing, my friends. But before I go into the charts, let's just review how bad is it out there? Okay, is this really the end of the world? What do we have? We have inflation. Excuse me, been there, done that. We've had high inflation before. We're all still alive. Nothing came of it. It's a normal part of our economic system as we know it. It comes and goes, inflation. It really does. We're currently in a high inflation environment. Soon enough, we'll be in a low inflation environment. It comes and goes. The Federal Reserve is, in response to it, raising its interest rates. Well, it's behind the curve. We all knew that. Remember, at the beginning of this year, I already said transitory inflation is BS. And why the Fed didn't react to it, don't know. It didn't. Fine. Been there, done that. Fed has been raising rates and lowering rates for as long as it's been around, pretty much. It's a normal part of the economic cycle. It comes and goes. We have the war in Russia and Ukraine. As sad and as unfortunate as it is, wars are a part of our society. Been there, done that. We've had so many wars. And what came of it? Yes, a lot of disaster and a lot of pain and misery. All those things aside, look where we are now. Is there a nuclear war threat? Yes. Well, if we're going to get a nuclear war, please look at the last bullet. Then the market will go to zero and society as we know it will cease to exist and we'll be dead. So why worry? There will be nothing to worry about anyway, because it will all be destroyed. Well, is that really going to happen? And did I miss anything of late? What else am I missing in the big picture? Earnings are down. Could be because of inflation. Yes, those are all baked into the inflation question. But otherwise, is there really currently an existential threat to our society? An existential threat to our way of living, economic system, and financial system. Anything like COVID. COVID, with its lockdowns and all those things, did indeed affect society quite severely. Do we have currently something that is similar to the near banking system collapse that we had in 2008, or the sovereign debt crisis we had in 2011, just to name the most recent ones over the last 10 to 20 years? None of it. Unless I'm missing something, again, please inform me. The current system and society is all we have. There is no plan B, and plan A will have to do. I know cryptocurrencies will most likely be financial system 3.0, but it won't be an entirely new system. It's still part of our current system. And our current system will go through expansions and contractions. Nothing out of the ordinary whatsoever, unless there's a black swan event. But that's why it's a black swan event. Nobody can foresee it. That's something else. But I cannot predict black swan events. Nobody can. So will the market then really go to zero? If we go to zero, then that's really it. We're done. Okay. We'll go into the halls of fame with the Egyptians, the Persians, the Mayans, and all those great civilizations. Okay. If not, then it's not the end of the world. So why do we really need to worry if it doesn't go to zero? So what's the downside risk? Maybe S&P 500, 2000, 1500 at the lowest. And what's the upside reward? Easily 10,000. It's actually unlimited upside reward. So please keep it in mind on the bigger picture and how things move forward if there is no real existential threat to our current way of living. I don't see it. If you do, please let me know. So I just want to put everything into perspective on why we're currently correcting as a market? Is it a bear market? All those things. No, honestly, no signs that tell me we're all going to die. That'd be something else. Then you might as well stop and give up. And otherwise, we just simply keep following the Elliott waves on the short term to intermediate to long term to tell us what is most likely going on. Start off with the Dow Jones. Here we have the hourly chart for the Dow Jones with our B wave high in about mid-April. And since then, the Dow Jones has been moving overlappingly lower. If this is indeed the C wave, which I think it is, then this is a ending diagonal C wave, which are a little bit hard to forecast because they're so overlapping. As I said on Wednesday, it takes about 75% of the data till you figure out it's an ending diagonal. Now, even the decline since Tuesday's high has been overlapping A, B, C, and now a big blast up into the close. Question is, did we have an A, B, C for 3 or all of 5? Okay, we got pretty close to some Fibonacci extensions, but haven't really reached it. This is a messy, nasty overlap, which reduces the confidence in telling you using Elliott Wave the low is in. So that's why we use the low risk, high risk levels to tell us, okay, hey, you know what? Maybe it's time to change hats and move from a bear hat to a bull hat. I also try to prevent labeling things as bull and bear market, because if you say it's a bear market, it instantly already makes your mental process negative. If you say, oh, it's a bull market, you instantly get positive. It's great to be positive. It's not so good to be negative. So just treat the market as the market. That's it. It's declining. It's declining. It's increasing. It's increasing. Don't put any labels on it because they will negatively affect you or positively affect you, and then you remain not objective. Hourly technical indicators are all positively diverging like there is no tomorrow, but we need to see price react. So we have, of course, certain price levels to watch. This is the daily chart. It still looks like a large correction. CSA was about 30,800, and we got to as low as 30,635. Close enough? Potentially. This starts to look better indeed as a ending diagonal, with the question mark if today was all of 5 or only 3 of 4, and we subdivide even lower. I can't tell you. And of course, today's low needs to hold. Then we have a low in place and we need to start making higher highs. I'll get to that in a moment. Positive divergence everywhere, so that's a good sign. It's a condition, it's not a signal. When do we get the signal? All right, high risk is if we can close back above this low here from a daily perspective. Okay, that's the high risk because there's a high chance of moving below this week's low. And then we need to break above the high at around 32,300, medium risk, and eventually back above this high is a low risk. Remember, I told you we'll lower the risk levels, the lower the market goes. Then we move on to the Nasdaq, regular Nasdaq. Excuse me. So far, counting this as a wave 3, a wave 4, and a potential wave 5, that ideally for a 5-1 relationship to target 10,600. But you can see we're right back in the ideal wave 5 target zone here in green. Okay. Maybe we're finishing a potential ending diagonal wave 5 of C. To be determined. It's not the first time we get all this tricky, nasty overlap. So we'll have to wait and see, and we'll use the Nasdaq 100 to tell us what are the low risk and the high risk entry points. But before I get there, let's zoom out. This is what I mean with the potential existential threat to our society, and we got to throw the baby with the bathwater out the window and hunker down because it's the end of the world as we know it. If we simply count corrective waves on a yearly time frame as down years, then we've done 5 up since the 2008 or 9 low, sorry, for the Nasdaq 100, 1, 2, 3, 4, 5. So that's why we have a label as a major 3, as we have here on the Nasdaq 100, 3, and we should now be in 4. 4 can become much more complex, but we're right in the ideal target zone, okay? So nothing out of the ordinary just yet. So are we in a bear market? Yeah, if 2008 was a bear market, sure, label it whatever you want to label. But please remember how often we have a down year versus how many up years we have. If you really go to the Dow Jones, 100 years of data, I don't show it here, there have only been 17 down years. out of those 100 years of data every year, 100 data points, 17 have been down years. I believe 3 have been 2 down years in a row. 3 have been 2 or 3 have been 3 down years in a row. So that brings the total to about 23. And 1 has only been 4 down years in a row, which was the 1929 till 1933 market crash. So that brings us to about 25 years. So out of 100 years, 25 are down years. So you have every year 25% chance, so to say, that you will have a down year. But most of those times, it's only a 1 year down year. As you can see here for the Nasdaq has mostly only 1 down year. 1, 2, 3, 4, 5, 6, 7, 8, 9. Since 1978 till 2022, we have so far only a few down years. So we have 44 years of data. 1, 2, 3, 4, 5, 6, 7, 8. Okay, 8 divided by 44. That's about 18 to 20%. Similar to about the Dow Jones, 20 to 25% chance you have a down year. Nothing out of the ordinary, massively overbought on the daily time frame. Can it turn into a much larger correction? Of course it can. That's something else. This is not predictive. But if you would not know this is the Nasdaq, if you would not know what the wave count is and simply look at the technical indicators, you go like, wow, we are crazy overbought. Yeah, pullback would be healthy, but the trend is strong. We're well above all the moving averages. The technical indicators look long and strong. It is a nice, healthy pullback before we move higher. That's the whole idea of this type of chart. Moving on then to the Nasdaq 100. So the high risk entry point is now, of course, yesterday's high. Okay, that is the previous high. So if we start getting above that one, we are starting to make a higher high. Just as we did on Tuesday, we barely made a higher high, but you can see that's a high risk entry. So now the high to medium risk entry, as I said on Wednesday, will lower these levels because eventually the threshold will be very slim or low for the market to jump over to start a new uptrend. The high to medium risk is, of course, Tuesday's close. Then a medium risk is at the previous Fed rally, etc. Okay. Ultimately, we need to break above this downtrend line and a few other ones, but those are, all things considered, high to low risk entry points. They're also, of course, simply based on, in a sense, on Elliott Wave, because once you start making higher highs, further subdivision of the previous wave must be excluded. So if the previous wave was a minute 5, starting from minute 4, you go back above minute 4, minute 5 cannot subdivide. If minute 3 was part of a minor 5, and then we break above minor 4, because that's where minor 5 starts, if you break above it, then minor 5 cannot subdivide, etc., etc., etc. So that's why you can easily identify high risk to low risk entry points, because ultimately, if we break above, of course, the high made here in late March, then this whole rally here cannot subdivide any lower. Then all we've done is 3 waves lower, and then it's most likely off to the races. Okay, so that's how I would go about with setting these levels, based, of course, on resistance. But those resistance levels are then also defined by the waves. If a wave gets broken to the upside, it cannot subdivide further to the downside. Then we have less risk of further continuation to the downside. Here is the Nasdaq 100 Elliott Wave count: 1, 2, 3, 4, 5. A nasty subdividing C wave, it appears. We got very close to the CSA extension. That was at about 11,600, I believe, and we got to as low as 11,492. We've bottomed so far once again in the ideal wave 5 of C target zone, 176 to 200% extension. Counting up and down days, it still looks like we should get one more step lower, like an up day and then a down day. It's not necessary. Of course, this is an additional system to try to track the waves. And here in gray is the ideal target zone for this wave 5 based on the length of wave 1. Normally, fifth wave is equal to the length of wave 1, but it can be also shorter, can also be longer. But here is 0.618 to 100%, and we bottomed right at the 76.4% extension of wave 1 for wave 5. Positive divergence galore, but that's a condition, not a trigger. Again, we need to start making higher highs and higher lows to consider that fact that we have put in a nice bottom. Doesn't have to be the bottom, can just be a bounce. We'll get there. So I have not even put those additional bigger picture roadmaps on the charts yet, because we have not even made a higher high. Until we do that, it's still questionable if we've really put in this wave 4 low. So here we have this trickster irregular expanded wave 4, A, B, C. No overlap with wave 1. Today we bottomed right here in the 200% to 176.4% extension of wave 1 measured from wave 2. Right smack in the middle. My ideal target zone was 37.50 plus or minus 50. I know it's quite large. We got to 38.10, getting pretty close. So if we now break above, I would say on an hourly basis, yesterday's high, it's a high risk entry, and we stair step our way higher. Same here, of course, low to medium risk is back above Tuesday's high, because then this wave 5 cannot subdivide anymore. Like I said, on Wednesday, I really started to run out of waves. Lots of positive divergence on technical indicators. So it's really started to look like these things are wrapping up nicely. But again, we really need to get back above yesterday's high, right? To make sure we cannot subdivide this any lower. So again, there's no signs of a bottom just yet in place. Using the daily chart, yesterday's high similarly, high risk, etc., etc. So please have a look. And where we currently are, one day doesn't make a summer. It really doesn't. We need to see a lot more continuation, and we'll take it day by day. Now, we topped January 3rd, and the whole year so far has been disaster, negative, you name it, right? It's not been fun whatsoever. It's been emotionally draining for traders, for investors, for your family, your friends, your pets, and I don't know what. It's been really taxing. So why? Because it's hard to make any money in a down market unless you actually use my trading systems. It's really hard. Most people lose money. That's the whole point of a big fat correction. To lose money, reset the clock, to get everybody out of the market and restart it over, rinse, lather, repeat. So it's been really taxing, and these 6 months have been taxing. So then the question is, are the next 6 months going to be equally bad like this? Are we going to stair step our way lower for the next 6 months similarly? Or are they even going to be worse? Or are they going to be better? I'm going to bet that the next 6 months are most likely going to be better. It's almost like, how much worse can it get? Are we going to see another 20% decline by end of year, right? We've done 6 months now. Are we going to see another 30% decline by the end of the year for technology sector? It's possible, but then we have to raise the question, is it likely? I don't see it. So please keep that in mind as well. Like, how likely is it that things are going to continue as bad as they are? If we're going to see another 20% correction from current levels, we'll be down at 3,000 for the S&P 500. Don't know yet. We'll see. Might be wrong. But anyway, so these are the Elliott Wave updates for these indexes. I'll soon get back on track with the semiconductors and IWM. I really want to focus on the big boys, which is always first and foremost the Dow Jones. That's the mother of all indexes. Nasdaq and technology are always kind of nice and clean, and the S&P 500 is the hybrid, kind of confused somewhere in between. Unfortunately, a lot of people do only follow the S&P 500, but you kind of have to know technology and the Dow Jones to get a better idea on what the S&P 500 does. That brings me to some market breadth data. Man, I would really like to see the bullish percent index drop to 0, like we've done several times, but it's completely washed out, that's for sure. But that would be fantastic to get this complete washed out, nothing is bullish anymore, so to say. That'd be fantastic lows. But again, we're getting pretty close, or have been close actually, to considerable and significant lows. Another way to measure things is the new 52-week lows on the NYA and the Nasdaq. And actually, they're starting to drop a little bit, as you can see. They're not as high anymore as they used to be. So it looks like we're starting to make less lows the further we go to the downside. Again, it's a condition, no sign. They're still way too high. they need to be below 50, and we're at 200, 300 plus. So they're still way too high. So again, it's a condition that we're dropping. We've seen it before, and the market did not respond to it. So it's just something to monitor. Something else to monitor is that the VIX is not playing balls either. The market is declining, and so is the VIX. So there's no spike. People say we need to see a spike lower. Well, then we need to change the trend the VIX is in all year so far, interestingly enough. Don't ask me why this is. I'm just showing you what it's doing. And the VIX is for now on a sell based on the MACD. Then we're going to look at money manager exposure. We can also look at other sentiment indicators, but this is one. The AEII is still very bearish, but I must admit, so far the bears have been right because we've been declining for the last 12 weeks that we have had so many bears. So the bears have been right, and then the question is, are they going to be right for the next 12 weeks? At some point, something's got to give. What's giving here is how low the exposure is of active money managers. 20% exposed to the market, so the 80% in cash. This is, of course, not necessarily a true number, but this is what they've reported. There's a difference between what you report and what you actually do, but it's quite darn low. We have not had many of these readings, though there's only data available since 2006. So that is about 16 years of data, but it is quite low. The last time was so low was, or actually lower, was 2020. Before that, we had to go back to 2015 and 14. As you can see, we can drop significantly lower. Would surprise me if it does even drop lower. And then, of course, during the bear market of 08 and 09, we had many low readings. That's for sure. But I only have data for one bear market, essentially, and one bull market. So it's a little hard to compare longer term data if you don't have it. But for now, it's a very underexposed market. That's for sure. Last but not least, the PMO buy all indicator. Today's data is not in. I'm pretty sure we won't have a buy signal either. So again, this one is really starting to look similarly to what we had March last year. This is a rubber band. The longer it's getting stretched, the harder the snapback will be. We saw it here in September. That was not as stretched as it was in March, but you can see it's absolute zero. Okay. No buy signal means no buy signal. We do want to see all, ducks in a row. We want to see them all aligned, have buy signals across the board. And so far, we're not seeing it. But I think once we get the buy signal, I wouldn't be surprised if we see something as fast and furious as we had in March and April of 2020. But we don't have it yet, and price must be respected. It's making lower lows and lower highs, and that's all we care about. Everything else is a cherry on the pie. But once all those signals align, we should be looking pretty good, I think, for the upside. So please review the charts on which price levels to watch. Just focus on the price levels. Whatever happens around us, we can't control anyway. We only can control our own lives and our own trading. We can't control the market either. We can try to interpret to the best of our knowledge. And it's been a tricky one, that's for sure. It was pretty easy, I would say, until we seemingly completed 5 waves slower, and then we got that darn subdivision going on. It can happen, but I think we're kind of well on track with the fact that wave 4 should have topped this week, and now this wave 5 is ongoing, and it will have topped when we break back above this week's high. Super simple. And meaning, or the bottom of wave 5 will be in once we break back above this week's high. Super simple. All right. So with that, thank you so much for listening. Take care, trade safe, and I see you all on Monday.